All right. So we will start our afternoon sessions with a paper on. Well, actually, let me. What was that's what's coming? Oh, for the speakers, I want to remind the speakers and discussants that we need your media release forms. So if you could either give those to me or Melissa, we would appreciate that. And we'll start the afternoon session with Can the World Finance the United States Debt? We're honored to have Dr. John Kitchen from the U.S. Treasury Department. And so off we go. Is this yours?
Thank you, John. Thank you as well to George and the Baker Institute, the Peterson Foundation, and Ernst & Young. I appreciate the opportunity to be here and talk with you today and to listen to others and hear some insights and ideas and concerns about the where we're headed as a nation and the debt outlook and the challenges we face. Let me start off also by saying that the views, any views expressed here are mine alone and not those of any institution with which I am or ever have been affiliated. And that is a necessary precondition so that if anybody ever says, oh, he said that, don't say, and he's from so-and-so, and that's their view too, because that's not necessarily the case. Let me start off by saying that the sense of what I was trying to do here, when I was given the invitation to participate, I thought, here are a couple opportunities of what directions I could go. One could be to write a summary review kind of paper that looks at what has already been done and try to just present information on that, some of the work that I'd done, others had done. Another alternative was to maybe try to provide some additional analytical and conceptual thought and analysis and approach, and the second one seemed more interesting than the first. So I've gone ahead and tried to take a step out into that, which is a little bit a newer way of trying to draw some things together. Now there are benefits and costs from that. One of the benefits is it's more interesting to do the new thing and the interesting thing. The cost is that it can be more difficult, and as I was getting closer to the deadline of having to turn in the paper, I was realizing that maybe it would have been easier to just write the summary document. But I also learned some things, and I hope maybe that this can help draw some of the information together for you as well and provide some more context and conceptual understanding of what's going on. So, Uncle Sam walks into a bar, and he says, "Drinks are on me," and everyone cheers, and they're happy, and the barkeep knows Uncle Sam's good for his tab, and so he goes ahead and provides the drinks. A couple years later, Uncle Sam walks into the bar and says, "Drinks are on me," but there's more people in the bar too at this point. And the barkeep says, "Sam, I know you've always been good for your tab, but I've got some concerns. It's getting to be a little bit higher, and there's more people here." And he turns to his left, and here there's an international government official sitting at the bar, and he looks over at the barkeep and says, "Don't worry, barkeep, I can help him out on that, and I'll cover some of that tab too." And he looks to his right, and there's Big Ben from Washington, not Pittsburgh, who got beat up pretty bad here in Houston this past week. So Big Ben is sitting there, and he's got a little machine where he can print out money. And so he prints out some bills, and he passes it over to the barkeep as well, and the barkeep says, "Okay, that'll work." But then the barkeep jacks his prices up a little bit. And so Uncle Sam says, "Okay, everything's working okay," and people are drinking, and they're happy. Goes out, comes back a few years later, walks in and says, "Barkeep, drinks are on me." And the barkeep says, "Sam, I think it's time you started settling up your tab here." And he looks over, and there's the international government guy sitting there, and he says, "Well, you'll help me out, won't you?" And he says, "No, the reason I'm here is because this is where I know I can find you." So that's the challenge I think we might be looking at, where somewhere down the road we're going to have to start paying it off, or the people that are out there drinking the drinks are going to have to pay for their own drinks and then pay for some of those that they've had in the past as well. And if you keep these three ideas in mind as we go through this presentation, that's the direction that I'm looking at things. There's basically three alternative sources of financing that can be used to fund government deficits and debt. One of them is private funding, the folks doing the drinking, and they're receiving the benefits as well. But also all the folks that are going to come in the bar later that are their kids would also presumably have to be on the hook for that. Or you can get the financing from foreign sources, and particularly foreign official sources, government. And the third one then is monetary financing, where the Federal Reserve can buy up more Treasury securities and provide the funding for that borrowing. So if you keep those three ideas in mind, that's the direction we're heading through here. And what I'm also going to look at then is what are the relative economic benefits and costs associated with these alternative sources of financing. We know that in economics we say there's no such thing as a free lunch. It's an old adage. So as we look at the alternative sources of financing, there are going to be alternative costs that are going to be associated with that, alternative economic effects. And I'm going to try then to pull in those economic effects, estimate them. In a sense, we're talking about dynamic analysis, whereas you have a change to a given policy, you're going to include the economic effects and the budget effects from those economic effects. And so I'll look at that over the different types of scenarios and different sources of financing. So it's a step beyond what is often presented, say, by CBO, where CBO will present an alternative policy scenario, but they'll do it relative to their baseline without changing the economics or including the budget costs of those changing economics, particularly differences in interest rates, differences in GDP growth that can occur. And then I'll fold that in and show you as well how that can have implications for both the level of the debt relative to GDP, or actually in this case GNP, gross national product, because what matters is, as we go forward, the income that we keep in the United States is going to be affected by how much we borrow from abroad and have to pay on the debt, the interest that we have to pay on the debt for those who hold, foreigners who hold our debt. As we have to pay more abroad relative to what we take in from assets we own abroad, our income could end up being lower. So to the extent that we have more and more exposure to foreign funding, we could end up with lower level of income and standard of living in the United States on which to then fund the debt and the deficit and in the future. So try to keep those three concepts together of the alternative source of financing and the budget and economic effects, and that's what everything is going to be, how everything is going to be going on here. And one other last point is Joel Procton gave a lot of discussion last night, and there's a lot of what I'm going to say is going to be echoing some of what he said. And there are good things and bad things about that. The good things are there's maybe some confirmation going on here of looking at how things are being looked at. The bad things are if you have two economists that agree on something, it might be like universes colliding and things are, it's a bad thing. But let's go from here. So can U.S. and advanced economy debt be financed? There are fundamental budget and external imbalances. Most of the budget ones we've been talking about, we've been seeing throughout the discussion here in this conference. And they are unsustainable in the long run under current policies, and there are also large external imbalances that we're facing with large trade deficits and financial flows. So under current policies in the long run, the answer is simply no. Okay, so the question was, can the world finance the U.S. debt, deficit, whatever the exact title was that John had put down there? And the answer in the long run is no, under current policies. And in fact, it's even the case where it didn't want to even be told that it's undefined. We don't even know, we can't actually estimate it because as we include the feedback costs from rising debt and deficits, interest costs, it begins to feed upon itself, and the base of GNP and the budget relative to that become essentially undefined. Okay, so what about in the short run or the intermediate run? And so that's what this analysis is going to look at. And so the answer is yes, we can finance it, but, and that's a big but in the sense that it's not clear exactly where it's going to come from and what the economic effects and costs will be. So that's what this analysis considers. Well, fasten your seatbelt because I'm going to run through this next section really fast with some background information on where we are, where we have been, try to provide some context so that we can then understand what the future is going to look like. So Treasury debt and official holdings, there are four, as we've been saying, there are basically four different components of the holdings. This is an equation from the paper. This chart shows the same thing, where there is domestic private holdings of Treasury securities. There are, the Fed holds Treasury securities. Foreign official governments, sovereign wealth funds hold U.S. Treasury securities. And then there are foreign private folks holding U.S. Treasury securities. We've already talked about how the debt has doubled basically over the past 6 to 8 years, from about $4.5 trillion to now over $9 trillion. This is also from about 35% of GDP to 65% of GDP. A large part of that increase over the last 5 years has been in foreign official holdings. And it also, this is trillions of dollars. It's also been rising then as a share of the economy, where foreign official holdings have gone from 10% a decade ago to almost 30% now, relative to our GDP. So the importance of foreign official holdings relative to the size of our economy has been getting bigger and bigger and bigger. Now, who's holding all that? About half of it is foreign held, and half of that isn't from Southeast Asia. This is Treasury International Capital data, which shows the identified holders of Treasury securities by country. This isn't even exact data because there are some financial centers that you don't know who is actually behind that data, including UK and Caribbean banking centers. So the Chinese or Japanese holdings could be even higher if they're held through an intermediary. But a large share of that then is China, as we've heard in the past. Now, there's even more debt, though, than the public debt. That first chart I showed you was U.S. Treasury securities, U.S. public debt. When you look at other debt beyond the Treasury debt, there are other government-sponsored enterprises and agencies that have borrowed, and you can think of Fannie Mae and Freddie Mac in particular here. And you can see that that's another $7 to $8 trillion worth of debt that is out there. Some of this has now been held by the Fed. You can see that dark red section as the Fed undertook its large-scale asset purchases, quantitative easing approaches. Some of it was held by the U.S. Treasury as well when the Treasury intervened and bought $225 billion face value of Fannie Mae. And they have been selling off some of that over time, but then they basically, I think, trailed that off because of the market conditions weren't allowing that. The Fed as well had a large, over $1 trillion purchase of these government-sponsored enterprise securities, and they had started to sell it off, to let it run off exactly as it matured, and then buying Treasury securities to keep its balance sheet the same size. They have halted that now and are now reinvesting the runoff into the GSE mortgage-backed securities again. So as we look at the Fed balance sheet, then we were talking about Big Ben sitting there running the printing press to buy it, telling the barkeep, keep that liquidity flowing. Well, this is kind of a psychedelic dream picture of sorts, or some might think a nightmare from the financial crisis. And so all the different vehicles and loan facilities that existed during the crisis. But now it has transitioned from a balance sheet that was, say, about $800 billion to nearly $3 trillion of the size of the balance sheet and the Federal Reserve holdings of securities. The bottom big blue part is Treasury, and it used to be almost all Treasury, but now it's also MBSs and agency securities and some other cats and dogs up there like Maiden Lane and whatnot. But the bottom line here is that the Fed balance sheet has almost tripled in size, and this has led to a lot of concern with letters from members of Congress to Chairman Bernanke, presidential candidates saying inopportune things, and criticisms abounding as to how inflationary this might be in the end. But again, I think Joel mentioned last night that even though the monetary base and the Federal Reserve balance sheet is increasing so much in size, the money multiplier has fallen dramatically. So money supply and inflation pressures currently aren't immediately obvious. Okay, so the implications for international trade and income flows. This is just simply a Keynesian international macroeconomic identity. The left-hand side is the uses of funds, and the right-hand side is the sources. That G minus T is the budget deficit. The I is investment. So the deficit and our private domestic investment have to be funded by private saving or the net financial flows, which is the exact mirror then of the trade deficit. Here's what it looks like in a picture where the red line is the net financial flows, including private and public. The blue line is the net export deficit for the United States, which they should be equal except for the statistical discrepancy. And then the black hatched line, or diamond line, is the foreign official holdings. So much of the change in the financial flows, in the international flows for the United States, have in fact, over the past 6 to 8 years, been in fact in foreign official flows, as there's been increased purchases of treasuries. Where is that next net export deficit coming from at this point? Oil and China is a big part of, is almost a predominant part of it. U.S. exchange value of dollar changed relative to many other countries, and so our net export position relative to them has improved. But much of the remaining deficit at this point can be associated with oil imports and the trade imbalance with China. And as we've had large net export deficits, we've also now had a worsening net international debt position. So this is the United States holdings of foreign assets relative to foreign holdings of dollar-denominated assets, and we are in debt. This chart shows the issue I said earlier. So the income side of the national income and product accounts. The top line 2 and 3 is what I talked about, is driving a wedge potentially between GDP and national income. So if the line 3 starts rising because of higher interest rates and higher borrowing from abroad, the change between gross domestic product and gross national product and getting down into our income could widen. That 514 could grow very dramatically as interest rates rise, and it's being kept down currently by low interest rates. And that would then make us pay more abroad than we receive from abroad if that were to occur. Okay, so the alternative funding sources and the outlook. Why is this important? I think we've kind of discussed that. But the main thing here is that a lot of folks haven't explicitly accounted for exactly what the alternative funding sources are and what those implications would be. So this tries to identify some of that. Most private and public projections don't include that kind of information. So the baseline that I used was a CBO current law baseline, which did not include the continuation of the certain policies. In each of the alternatives, I added in those certain policies, which were indexation of the AMT parameters, the continuation of most of the Bush tax cuts, and the Medicare provisions. These are the same ones that CBO identified as the continuation of certain policies. So the alternatives would be private funding, foreign funding, Federal Reserve funding, monetizing the debt, and then I threw in another final one just to try to draw it back into this conference a little bit more, where I said, what would happen if you had significant fundamental budget and tax reform? What would that look like in these scenarios as well? So the economic and budget effects include inflation, interest rates, GDP and GNP, the budget effects and public debt relative to GNP, again, because that's the money we have available, not GDP, to fund that. Net exports, net international debt position, and net income flows. So anything that's happening in the domestic economy, I've also estimated how that's going to affect our net debt position and the implications for how we are then able to receive income from abroad or pay income on our debt. And so it also looks at then what the implications are for the size of a foreign official holdings. How big are they going to get under these alternative scenarios, and whether that's something that's manageable relative to how big the rest of the world economy is, how big that would have to be. Now here's just a quick diagram that would describe some of the alternatives. If you had all private funding, for example, where the United States is going to fund, private funding from the United States is going to fund deficits, we would have the classic case of investment crowding out. All private funding, interest rates rise, investment gets crowded out, GDP is lower. If we go to all foreign official funding in Part B there, point B, well, there's going to be a change in the exports and the exchange rate, and you'll end up with net export crowding out. And that's sort of the twin deficits position. High budget deficits, high net export deficits. And then the vertical axis is what happens if it's all done through Fed funding and monetizing the debt. Well, then you get higher inflation and you have real losses on bond holdings, real capital losses, and as the value of nominal bonds and nominal payments we get from previous years would be eroded. Okay, this is an equation that I took from the paper with Menzie Chin. This is what kind of draws it all together. As we have, this is the spread between the 10-year Treasury yield and the 3-month Treasury bill. So this is a term structure relationship. It's built from a Taylor rule and then adding in risk and uncertainty factors that are associated with budget deficits, foreign official holding, and then Federal Reserve funding. Now in this case, in the short run, Fed funding can help keep long-term rates low. In the longer run, Fed funding would tend to boost inflation and raise all these rates, both the short and long rates. So the key equation here in the way this model is structured and uses information is to use that. It says basically as the structural surplus, if the deficit is the negative of that. So if the deficit goes up by 1%, then the spread between the 10-year yield and the 3-month bill is going to go up by 33 basis points. If foreign official funding goes up by 1% of GDP, the long yield relative to short yield goes down by 33 basis points. If the Fed provides funding at 1% of GDP to buy long-term assets, it's also going to tend to pull the interest rates down by that 33 basis points. This is an estimated relationship over 25 years, and the information is in the paper that's forthcoming in International Finance. So we take that and use that to look at the economic and budget effects. We also look at GDP effects with a solo growth model. So as you change budget deficits, you affect domestic saving, and that is going to then as well affect the GDP. We use that solo growth model from that and generate reasonable results relative to others that have been generated. Inflation, exchange rates, interest rate effects from the Taylor rule for the short term, for the long term interest rate using that Kitchen and Chin equation. We also look at the budget effects then from each of these changes, incorporating them into these projections that sensitivities that were similar to those generated by CBO. And we look at net export changes and the net international effects. So the effects on nominal 10-year Treasury yield by scenario, I thought this would be interesting to start with to show you. Here's what gets estimated as to how the interest rates would change. By 2021, as we include the additional policies and the budget effects on interest rates in order to induce private funding, the long-term Treasury yield goes up by 1.25%, which is similar to what Joel was talking about yesterday. I think he was getting up maybe 2 percentage points, but it might have been out in a couple more years beyond this. If you have foreign official funding, the notion here was I wanted to see what level of foreign official funding would roughly keep the spread between long rates and short rates the same as in the base case. So in this case, it's by purpose and by design that the long rates are kept low. If we have Federal Reserve funding, the inflation premium rises and pushes rates up, and we could be as high as 8.7% on the 10-year yield by 2021. And under budget and tax reform, then, we are a little bit higher relative to the base. And in this case, it's because real GDP growth picks up and the real interest rate rises some with that stronger GDP growth. But that's the only effect why that's higher there. If we look at the deficit and debt as a percent of GDP, the base has minus a little about 1% of GDP by 2021. Again, maybe not a realistic base, but with a more realistic base, then we're at over 6% in either the private funding or the foreign official funding case. And with Federal Reserve funding, it's at 5.3. And budget and tax reform, we get back closer to balance. The budget and tax reform that I used here was assuming that there would be $4 trillion of budget savings and that there would be fundamental tax reform using some estimates that I'd seen in the literature as to the effects on beneficial effects on GDP. And I think I use a couple percent of GDP in here to get that effect. One of the key points here then is, as we look at sustainability, is the debt, the level of the federal debt as a percent of GNP. And under the base, which isn't necessarily realistic unless we allow all those tax cuts to expire, we are at 61%. If we go to private funding with higher interest rates, associated negative effects on GDP, all those higher budget costs, we're at 92%. Similar if we rely on foreign official funding, because we have a higher net export deficit, and we're going to then continue to still have costs that are associated with that in our budget. With Federal Reserve funding, we can actually flatten it out through higher inflation, the erosion of the debt burden because of higher inflation. And then finally, with fundamental budget and tax reform, we get into a much more sustainable situation. And I'm coming out of time here. This chart would show what happens to our net international indebtedness and the income flows associated with that. And I'll just highlight here that under foreign official funding, you can see we get the benefit of lower long-term interest rates from foreign official funding, but we end up with a debt to the rest of the world that's 68% of GNP by 2021 relative to 20 to 30% in the other scenarios. So it's a much worse international debt situation if we rely on foreign official funding. Here's an example of what it would be under that case. It would require foreign official funding to rise to as high as 16% of rest of world GDP from something more in the range of maybe about 3 or 4% of GDP, rest of world GDP currently. So that is a hard thing to imagine, that we can continue to rely on foreign official funding indefinitely, as well as the problem of all the imbalances it would create. And that's the challenge that we face with all of these, that there are unresolved imbalances in costs in these scenarios. If you have foreign official funding, there's a perpetuating international imbalances, perpetuating net export deficit, rising U.S. net international debt, and adverse international income flows where we have to pay more and more abroad all the time in order to finance that debt. And this will be particularly a problem as interest rates rise back up in coming years when we get out of the short-term financial crisis. Fed funding case, you have unresolved high inflation. Inflation gets up to, I think, about 5.5% in this scenario relative to 2% of the base case. And as we've seen in history, to resolve higher inflation can often require severe negative short-term output or unemployment effects, like in the 80-81 recession. So, and there are threats regarding potential asset price inflation or bubbles. This doesn't even include the slowdown of 2011. So the interest rate effect that started there in 2011 was at 3.3% on the 10-year Treasury yield. And right now we're looking at what, 1.9? Maybe 2% for the year, 2.25, somewhere in there. But so anyway, things are worse than these projections would suggest because we're starting off from a worse situation. So in summary, we've got alternatives for how we can finance the debt. We can probably do that, continue to do so in the short run. We'll probably continue to have some fair share of foreign international funding, but we're going to have costs associated with that. And there are winners and losers in this. If you're a net export sensitive industry or laborer and you have foreign official funding that is driving net export deficits, you can be a loser. There's a recent paper by Auteur and others from MIT that have identified that localized industries and regions that have been competitors with Chinese-produced products have fared worse than others over the last 5 years. So there's a cost to those. If you have Fed funding, there's a cost to bondholders, wealth holders, in terms of higher inflation. And the least costly would be if we have fundamental budget and tax reform and private funding. So that's a pretty simple conclusion, but it's the result that comes out of this. Thank you.
Thank you, John. That was excellent. The first discussant is Dr. Peter Hartley from Rice University.
Thank you very much, and I guess I've got to figure out which button to push here in a minute. Everyone else seems to have that problem. So I'm primarily, these days at least, focused on energy economics. But my approach in discussing this paper was to hit the computer and search the Federal Reserve FRED database and see what I could see based on that about some of these issues. Yeah, I had trouble with the button. It's the square one, is it?
It's the arrow on the right-hand side of the circle.
Ah, there we go. So the first thing here is John's done a very good job already, actually, of presenting his paper. So as he mentioned, the three main sinks for US government debt: private saving, foreign official purchases of treasuries, and Federal Reserve monetization of the debt. The balance of funding is not really under the control of the US. He makes that point in the paper, but it doesn't really matter because no matter how it pans out, there are negative effects associated with all three. And he's arguing, as he just mentioned, the fundamental readjustment's less costly in the long run. He already presented this picture, which summarises the three main costs as he sees it from each of the, or the main costs from each of the three types of funding. And I'm going to come back to that point. Also, it turns out, the two equations I picked out, the key one that he mentions in his paper with Menzies Chin. So the Fed policy reaction rule motivates the unemployment and inflation gap terms, and the negative coefficient on the structural surplus, as he mentioned, reflects reduced supply of treasuries if you have a higher surplus. Foreign official Fed demand for treasuries reduce the long-term interest rates. And then the three different forms of funding differ going on this equation because private funding requires higher interest rates, further affecting growth. With foreign funding, you have an increase in this foreign variable, which offsets the decline in the structural surplus. So the yield spread is unaffected, but the net export decline cuts growth. And in the monetization case, again, you'd have the Fed and the structural surplus offset, but then the inflation rate changes. A further illustration of the argument, he had this accounting identity. And so the deficit on the left has to be funded by savings on net exports. He remarks that the third alternative, monetization, is not readily apparent in the equation. But it seems to me, if you think about the erosion of wealth from the bond holding and so on, that would show up in consumption, and therefore the savings part of that equation. So if you measure income properly, there should be a minus, a sort of a capital loss from nominal assets that's in your income measure, which would then affect Y minus C on the right-hand side. The other thing is anticipated inflation is also likely to affect growth as a result of non-indexation of the tax system. He didn't mention that in the paper. It was sort of focusing on this erosion of real wealth, but it seems to me even if you have anticipated inflation, particularly with depreciation allowances fixed in nominal terms, in effect you raise the tax rate on capital. And I would have thought that would have been a significant negative impact of anticipated inflation over and above this erosion in the value of nominal assets that he talked about. So anyway, what I did then was I mentioned I went to check out a lot of data on this, and some of these pictures are basically the same as the ones he just showed, very similar. Here's the, he didn't have this one, but this is actually what we're talking about. This is the federal deficit, or surplus if negative, and you can see that there's only this little bit right here in the Clinton years where it was actually a surplus. The rest of the time it was a deficit. And of course, big increase in the deficit here in the last few years. So this is the thing that we're talking about we have to finance. And I got this measure of gross federal debt outstanding from the Federal Reserve database, which is different to his measure. I think the difference might be, I didn't have time to sort of track all this down, but maybe it's the debt held by government enterprises, perhaps? Social Security. Trust fund, yeah. So I think that's the difference. So this one here just is gross debt outstanding, which just doesn't include doesn't subtract out those. But still, it's growing. So I guess that's another source of funding implicitly in here would be if you had more from that. This is a consequence of the growth in debt, of course, is the growth in interest payments. So, in fact, if you compare this with the budget deficit that we were just talking about, 1.5 trillion, a fair chunk of that actually is just interest on the debt. And then this is the part that's held by foreign international investors, getting up toward the 5 trillion mark. Okay, and then as he mentioned, there's also been some of this debt's been monetised, and here is this picture he showed as well. This dip here was where the Fed actually purchased these they sold Treasury assets and purchased mortgage-backed securities and so on. But as has been pointed out, there's a terrific increase here in the amount of debt, which has resulted in a big increase in the base money supply. Okay. So according to his model, this big increase in the base money supply should have given us a lot of inflation. And you might think that that would have also had this impact on interest rates and exchange rates. Well, let's look at the interest rates. So here's I go to the database and I pull off the interest rates. And so here we have I got the 10-year Treasury and the 1-year Treasury. And of course we've seen a big decrease in interest rates. And every time you have the recession, of course, this yield gap opens up that he talked about, like in the equation. But certainly, you're looking at this and you're going to say, well, we don't see this big increase in interest rates yet from this big increase in debt. And if we think about, okay, that big money growth is supposed to lead to inflation. Well, this is the all item CPI. We had inflation tick above 3% measured on that rate, but thus far at least, it looks like we've had this big monetary expansion. We haven't had to pay for it in the way he was talking about. Now, of course, the CPI, if we go to the producer level, producer prices, which maybe presage what's going to happen at the consumer level, the inflation rate here, annual inflation rate, is already above 10% on producer prices. And of course, we did have this period of big deflation. And if we think about another way of thinking about what's going to happen with inflation is to look at inflationary expectations as represented by the difference between the interest rate on normal treasuries and the inflation-protected treasuries, the TIPS, so the ones that are indexed for inflation. And what you can see there, the gap is only a couple of percent. But the real interest rate is measured by the return on TIPS is incredibly low by historical standards, and it's actually been dropping for the last 4 years or so. So again, we haven't seen this big increase in interest rates. We don't seem to have seen the increase in inflation. One reason is, I think, a major reason is that we've had a big drop in the money multiplier. So another way of saying that is there's been a big increase in the demand for very liquid, more liquid assets, right? So this big expansion in liquidity has actually been held by the private sector. In fact, if it hadn't have had the liquidity expansion, the big increase in demand for liquidity probably would have put us into another Great Depression. So we've been able to have this monetary expansion and get away with it because there's been a big increase in money demand. Okay, on the international side, again, we haven't had a big increase in a big revaluation of the exchange rate, which would give us the balance of trade deficit. We've had these few periods, but hasn't seen it. And one of the reasons, of course, is that the US is not the only party here that's running a big budget deficit. We also have had a lot in Europe, and as there have been problems in Europe, people have switched into the US assets. So, sort of just summarise this up, I guess the point I'm making is that we haven't seen a big problem from a lot of these things yet that John's talking about. But I think it's been because there's been a big increase in demand for liquidity at the domestic level, which has masked a lot of these potential effects. At the international level, actually, the demand for the US dollar as a reserve currency has been dropping. You can see that it was compensated by a big increase in the demand for the euro, which is the red area, until Europe itself got into trouble. And so in the last year or so, or a couple of years, basically the level of euros has remained the same, and there's been an increase in demand for some other currencies. But part of the story there is, insofar as there's an increase in the demand for the US dollar as a medium of exchange internationally, it's sort of like the increase in demand for liquidity domestically. I think it could mask the kind of effects he's talking about. The US effectively gets seniorage on, so it can issue US dollar denominated liabilities as long as people want to hold them, either because they want highly liquid assets domestically, or you want to hold it for financial international transactions, you can get away with it. But the bottom line here is how long can you do it? So this is my final slide. So the focus of the paper is the longer term difficulties. So it focuses on anticipated inflation and so on. But it seems to me if we want to consider the effects of the current fiscal imbalance in a more general sense, are the short run difficulties going to be substantial as well? So we've had an extraordinary liquidity expansion. The extra liquidity has to date been demanded, but how long can that last? And what happens when it ends? People switch back to a more normal holding of monetary assets. Real interest rates are incredibly low, and I can't imagine that lasting for very long. And what might happen if much of the rest of the world ceases to abet the US in abusing its reserve currency status? Thank you very much.
Our second discussant is Dr. John Moody from Grinnell College.
So I'd like to thank George and John for extending an invitation to come and be part of this exciting seminar that we've been having here. In terms of time horizon, I think that's a big part of the story that we're looking at in John's paper. We should recognize that last night we heard quite a bit about what should be short-run macroeconomic focus. Was it a time for more stimulus or not? John's paper, though, I think should be characterized as looking at an intermediate time horizon that as he showed in most of the little clips of how we deviated from the baseline. He was looking at 2016 and 2021, which I think is a useful way to think of this, that we're not so much debating how much additional Keynesian stimulus needs to be applied right now. Instead, we're looking at, once we have recovered from that downturn, what are the longer run issues that arise, and saying how is the United States going to contend or finance the budget deficits that are on the books and look like they don't have any easy way of disappearing at all. So I think John's time horizon gets us focusing on the heart of the problem. Not that we're needing to get in a big debate about Keynesianism. Instead, we ought to be looking at what do we need to do in order to solve a budget problem that certainly is going to exist in 2016, 2021, and much further out into the future. And John's answer is that there clearly is no free lunch, that any of these alternatives we look at certainly have costs attached to them. And not only that we want to look at those costs, but on top of that, we want to be making sure that we are allowing for them all in a consistent framework, that we've looked at them in a way that allows for various interactions within an economy. So if what we say is happening on the domestic front is consistent with what we anticipate is happening on the international front as well. So I found this a real useful paper to look at, although I will have to admit that I am not entirely on top of all of what John has told us. So this is going to be, I'll put up a slide to see if I can check through my line of reasoning matched what John told us, and I can see I might not exactly have all these pieces right. But the first story is that John is going to be relying on CBO projections. So he doesn't have to come up with a model that basically projects the future. He's going to be saying, what did the CBO predict? And then where are we going to get deviations from the CBO baseline projection, especially if we have this situation where we're not going to fulfill the conditions of current law. Instead, we're likely to have a lot of other programs continued, and that's going to create an additional deficit. And the question becomes then, how are we going to finance that additional deficit? And John lays out these alternative approaches we might take. As he indicated, there's going to be a key element to look at in terms of how does financing the deficit potentially affect the interest rate gap, and he relies on some work that he did with Minzy Chin. So we've seen that material already, and I'll even go ahead and look at it again. But we also are going to assume some other types of economic behavior. We're going to assume that the Fed is going to respond to any changes in inflation or changes in gaps of unemployment following a Taylor rule. We're going to look at what some of the implications of changes in interest rates would be, and we're going to use a solo model. And this may be where I'm maybe a little off base. Are we looking at exactly how the capital stock has to change in order to be consistent with a higher long-term real interest rate, or are we looking at what the adjustment in the savings behavior is? So for people who are much more aware of how all these elements have to fit together, you can correct me in terms of how that tells our story of adjustments. But because we know the solo model is telling us something about GDP and output in an economy, we still need to say what's left over for American individuals and corporations after we have paid the foreigners. And therefore, John has another interesting paper referred to as the U.S. as sharecroppers or shrewd capitalists that looks at some of this change in net international income payments and net international indebtedness. So it's going to draw on several pieces of work that are integrated together in this model. And as a result, I think that there's a lot going on, a lot to keep straight, and it gives us a richness of the story as well. So all of us have focused on that one equation, and maybe that's a good equation to have up there, not because we want to discuss the econometrics or not because we want to particularly say that's the most important part of the model, but it's a very nice, concise way of summarizing what's at stake in this model. That it gives a very good shorthand for saying how would we allow for these alternative avenues to finance a government budget deficit. So John's already run through that very carefully in terms of what we might interpret each of those individual items to represent. The first couple of terms showing the short-run Federal Reserve reaction, and the last three items telling us something about longer-run financing of the deficit. So we've got three different scenarios to consider. The case in terms of John's little triangle, we could look at monetizing a debt, we could look at selling the debt to foreign official entities, or we could look at selling it to private domestic individuals. And if we looked at that first scenario then, the one of having the structural surplus decline, we can see that that implies that we would be getting an increase in the long-term interest rate. And so that would be our story of why we're going to get investment crowded out. Now, if we ought to recognize, though, that this is a story about domestic investment. Over the time period that equation was estimated, we also had interest rates determined by not just domestic purchases, but also foreign private purchases. So there's a little bit of a question as to how big would that coefficient be if we limited our intervention only to domestic purchasers of that long-term debt. So would we get a slightly bigger increase in that interest rate? John's got a more elaborate story that would apply to give us the stylized example where the crowding out is only with respect to private domestic finance. And the more elaborate structure is to say that if the interest rate goes up in the United States, it also has got to go up in other countries, so that we would end up with no reason for there to be an additional inflow of foreign private funding. So there's some other things going on in the background. If we said that rising interest rates in the United States were to attract greater private capital inflows, then we'd be getting a little bit more of the crowding out story involved with this scenario too. So that it's not saying that couldn't happen. It's just saying to get our three polar cases, it's convenient to be able to rule out foreign private flows. And when we do that, one thing that we can focus on then alone is just the domestic crowding out story. If we go on to the second scenario then, if we were to look at the foreign official entities buying the debt, as John indicated, that's a very familiar story from the twin deficits of the 1980s. And if we were looking at that sort of a story, we probably find trade economists would be very worried about, well, what are the elasticities of demand for exports and imports you're assuming here? But John's framework is a very useful one for reminding us we don't have to stumble over all those stories, that if we're going to look at how the balance of sources and uses of funds is established in that bottom line, we need to say that if the deficit goes up, there will be a sufficient appreciation to crowd out the net export side of the economy. And I wasn't quite sure John refers to that as the trade deficit. I assume that that's the current account story if we're keeping straight exactly which international transactions we're looking at. But that would be one of the key elements of the story then, to look at crowding out. If you on the left-hand side, if G minus T is going to go up, then we've got to have X minus M changing on the right-hand side as well. So if we were to say, well, if foreign official purchases of assets are going to take place, if we looked back in time, in the 1960s, we typically said, well, why do people hold foreign official assets? We typically said that was an accommodating transaction, and it was because we were twisting the arms of central bankers to be willing to hold those assets. By the 1970s, our story had changed somewhat, and we said, well, no, OPEC is holding all those dollar assets, and they're doing it because it's the very best asset to hold. It's got liquidity properties, the highest rate of return for risk that makes it attractive to hold that. And then we might ask, well, is that the same reason people hold foreign official reserves today? And we'd probably say, well, maybe that those properties of holding dollars are not quite so central to the story, because it would appear that we have countries that are willing to accumulate dollars as sort of a side effect in terms of a broader goal of saying we are interested in an export growth model of development, and within that model we particularly need to have an undervalued exchange rate to accomplish that. So accumulating the dollars may be incidental to achieving some broader goal that they are interested in. And Kitchen and Chin raised a very perceptive point, saying, well, what if those foreign countries were not actually accomplishing that goal of faster and faster export-led growth? Would they be quite so willing to continue to hold on to dollars? And I think that is a very relevant question to raise. Now, last night, Joel got the question that said, are the Chinese going to continue to be willing to hold dollars? And if we were trying to predict, well, when are they going to say they've got enough, that's something economists probably don't have great expertise at saying exactly when are we going to hit that tipping point. But Kitchen and Chen also cite some evidence of others showing that basically it would be possible for the United States to continue to sell these dollar assets in the intermediate run, as long as the U.S. share of those foreign portfolios just matched the U.S. share of world capitalization. That there's space for this to occur, in other words. Thank you very much. So I will move ahead to our final sort of alternative, and that was the question of monetization by the Fed. I'll leave that aside because I'm not so sure that monetization by the Fed is one that I would say anything new and different. Let me instead go back to say, what about monetization by foreign central banks? What if the dollars that foreign central banks are accumulating end up giving us a situation where we have rising money supplies abroad, rising inflation abroad, where we have a smaller foreign surplus with the United States? If there is that smaller surplus, then we're basically saying there are fewer foreign funds to fund the United States budget deficit, and we're more likely to have to rely on scenarios 1 or 3. So I particularly like John's paper because it makes it very stark that there aren't that many options out there, and none of the options are all that attractive.
Okay. I guess I'll just have John up to respond and maybe take a couple of quick, brief questions so we can move on to our next session.
Okay, thanks very much for the helpful comments. I appreciate both of the discussants taking the time to read the paper and from what I can see, carefully consider it. And the main point I think I would make is that I didn't mention when I was first making the discussion, or giving the discussion, that this wasn't going to consider anything associated. What is the short-run cyclical transition? And I just ran away from that question. Okay, I wanted to focus more on what happens once we get back out of this short-run challenge situation and back when we know that eventually we're going to be not having the case where the flight to quality helps keep our interest rates so low, when our exorbitant privilege as the world's reserve currency might begin to erode some, and as we face those challenges, what would be the implications? So thank you for raising that, and I think I should make more discussion of that in the paper. And also, I think as well, some of the points that were raised indicates that I need to put a little more context in having a recognition of how this fits in with what others have done and what the situation is as well. And I think I'll leave it at that and just open it up in case there are any questions.
Thank you.
Good.